Joining me now is Payden and Rygel chief economist Jeffrey Cleveland. What to make of the trade issue that seems to have been rocking markets lately, but this all started, the volatility came back with a vengeance in early February because of concerns about inflation and higher interest rates. So what is it?
Well, I think the trade story is like so many narratives in the market. You know, people get really attached to them. It dominates headlines, and then it goes away because we make too much of it. That's how I remember last year and the Fed's balance sheet story. Remember how the Fed was going to shrink its balance sheet and it was going to be a big deal? That didn't happen. Before that, you had things like the fiscal cliff. So I think that's what for me, the trade story is. It doesn't change our overall growth outlook.
But is that true, though? Because you're immediately seeing impact to steel prices, pork prices, soybean prices. So that's impacting the farmers in the Midwest. But then when does that creep into sentiment numbers for the consumer, for businesses? I know small business sentiment was at a new high in the most recent reading. So I feel like once it creeps into those numbers, you could really start to see an economic impact.
Yeah, I think you're exactly right. If you look at, you do have market moves, you have volatility. The question is, does that feed into the actual economic data? The earliest read of that, I think, would be a small business survey, which has come off a little bit from the highs, but is still very elevated. So I don't think the market volatility has bled through into the economic outlook. And I think the story really is going back to the inflation story. I mean, we had that shock early February with the jobs report, the average hourly earnings number. I think that set off a repricing in the bond market, which bled through into equities. So it's really, for me, the inflation story that's driving everything here. And I think today,
we get CPI today. The core is expected to be 2.1% by Bloomberg's latest survey. That's the first time it's over 2% in a handful of months, at least. I'm not exactly sure. What's your take on that if we get that more than 2% number?
Yeah, I mean, I don't want to make too much of it. This is not the 1970s. This is not stagflation or anything like that. I do think 2.1%. That 2% is a real critical threshold for the bond market because the 2% number is the number that the Fed is targeting. So if, the bond market has been complacent for months because inflation was low, it was sub 2%, you suddenly get above 2%, just psychologically, I think that changes the game. And then people start looking around. You know how it works. Looking around, they start seeing inflation everywhere. So they're going to start seeing it in, the aluminum prices and oil prices.
Well, they're going to see it at the pump this summer.
Yep. Exactly. Gasoline prices.
And that changes sentiment because, again, that's one inflation gauge that people relate to from East Coast to West Coast.
Hits the consumer's wallet directly. Jamie Dimon's been really warning about the potential for higher inflation going forward, too. So this maybe could be just the beginning. We're getting into earnings season, and a lot of the bulls are hanging their hat on earnings really being what's going to calm this market. Do you believe that? We'll get a look at the fundamentals.
I think near term, I do worry that the inflation story will surprise the market. We'll get another repricing in interest rates. That will have a knock-on effect on the equity market. So there's a short term. So that's, I think, over the next 3 months, let's say. Longer term, what I'm worried about is, and what I'm going to focus on is, do we continue to see the unemployment rate fall? If the unemployment rate falls below 4%, I think that's good for the consumer. I think that's good for earnings. So it's really that story that I think over the 6 to 12 month time frame that will be more important. And I think that will happen. I think the unemployment rate falls below 4% in the next few months. And that's fantastic. We have only been that low on the unemployment rate 3 times in the post-war era. Late 60s, late 90s for a few months, and the late 50s.
Jeffrey, good to see you. Jeffrey Cleveland,
nice to see you.
Payden and Rygel. Take care.